Hello and welcome. Today we will see a trading strategy based on crude oil futures. We know that markets have reactions and counter-reactions. Therefore, moves that go up are bound to go down, while moves that go down are bound to go up eventually. We also know that strategies are cyclical and do not perform the same way across timeframes. This means that a strategy specifically designed on the hourly timeframe is unlikely to work on the 15-minute timeframe, which is why extensive research and stress testing must be done. So the strategy we're about to see is a hybrid between contrarian and trend following, and uses two indicators to get its signals on the 15-minute time frame. However, it can be unusual due to its exit and entry conditions, but as we progress, we will start to understand how to use it. Let's start with the basic and first indicator, so the relative strength index, aka the RSI. This momentum indicator is known and a powerful tool that helps us detect inflection points. Generally, the RSI is mostly used with the oversold and overbought conditions. So by approaching the oversold area, so this area around here, we will start to have a bullish bias, and while approaching the upper part, which is also called the overbought area, we will start to have a bearish bias. So the strategy's default look-back value for the RSI would be 8. So in our example here, we will be using an 8-period RSI. Note that the default value of this indicator is 14, but a lot of strategies out there tweak it so it performs better on some markets and timeframes. After all, trading is adapting. In our strategy, our oversold level will be 25, and our overbought level will be 75, meaning that whenever the RSI is close to 75, we should not think about buying opportunities, and whenever it's close to 25, we should not really think about any selling opportunities. Let's now proceed to the second indicator in our strategy. Remember, the strategy is twofold. So one, we have the RSI, the 8-period RSI, which would give us signals, but there's also another indicator, which is the Fibonacci Moving Average. So moving averages are well-known trend-following overlay indicators, and they come in many shapes and forms. They can be simple, exponential, smooth, or even weighted. However, for this strategy, we will use a more exotic one. It's called the Fibonacci Moving Average. Now, Fibonacci is well known in the trading world, but where does it come from? The Fibonacci sequence follows a distinct pattern of numbers where each number equals the sum of the previous two Fibonacci numbers. Therefore, by starting from 0 and 1, we will obtain 1, 2, 3, 5, 8, 13, and so on and so forth. The Fibonacci moving average calculates two types of 15 exponential moving averages, with each using a Fibonacci number as the look-back period, starting from 5. Meaning that we will calculate the 5-period, 8-period, 13-period until we reach the 15th Fibonacci number, and then simply divide the results of the 15 exponential moving averages by their number, thus by 15. So the Fibonacci moving average is generally calculated on both highs and lows. So instead of averaging over the close price, we will average on the high and low, thus giving us a moving zone, as we can see on the chart. Now this indicator can be found on TradingView by simply typing it in the indicator search bar. Now, what is our strategy? Is it trend following or contrarian? Well, both, because the answer lies in the gray zone. Basically, we are expecting a reaction from the moving average zone and a continuation in the initial trend. But at the same time, we are using an RSI, so we are using a contrarian indicator. Thus, the strategy is a hybrid between trend following and contrarian. So, what are the trading rules? A buy signal is generated whenever the market closes inside the moving average zone, so meaning that the close price must be below the upper Fibonacci moving average and above the lower Fibonacci moving average, while simultaneously we must have an 8-period RSI that is at or around 25. This means that we have a market on support. Now, all we need is the entry and exit conditions. So the entry is done at the open the moment we hit the zone, meaning that here we have closed below the upper Fibonacci moving average and above the lower Fibonacci moving average, which gives us a buy signal. Now we will initiate the trade on the open of the next bar, of course on the condition that the previous close was around 25, which is the case as can be seen here. So the take profit order must be 4 times the difference between the two moving average on the close, meaning that in here we can see that the upper Fibonacci moving average is 91.48 and the lower one was 91.08. So meaning that the difference between the two is projected 4 times above the open price of the trade. So that this difference here will be added as of here, so the opening price of the trade multiplied by 4. This will give us our target. And we will do the same thing for the stop, except that we will multiply it by 2 and subtract it from the opening price. This will give us a 2.0 risk-reward ratio trade. So let's see the details of this buy signal here. Note that the previous high was 91.48 and the previous low was 91.08. Of course, we are talking about the Fibonacci zone, meaning that our high, which will be taken into consideration for the risk management, is 91.48, the low 91.08. And of course we will use it with the open, so we have initiated the open here and it's at 91.44. This should give us, if you can just make an arrow around here to represent our buy signal from the opening price, and then we can calculate the take profit order as we have discussed earlier, which will give us 93.04, meaning that when we enter here we will be targeting 93.04. So this will be our target. However, for the stop, it will be 90.64 as per the formula we have just discussed. So by entering here, we have managed to get away with a few inches out of the stop, and then finally we were lucky enough to hit the target before hitting the stop. Let's now see another example of a short trade. So in this chart, we can see that we have instances where the market reverts back to the Fibonacci moving average. However, we can also see that the RSI is not quite on its overbought level, meaning that a sell signal should not be generated. But also notice here that we have entered the Fibonacci zone, meaning that if we can zoom in, we can see that the close was inside the zone, while we have an RSI that is above the overbought level, so it's above 75. This means that we have a sell signal. Now previously here we had also an RSI that was around the overbought level, but the moving average was quite far from the market price. This is why the confirmed signal is around here. Now for the trading conditions, we have a high of the Fibonacci at 62.06, we have a low at 71.83, and the opening price is at 71.90. So let us draw our arrow, our bearish arrow, from the opening price of the trade and set our target accordingly. So as we have said, it's 4 times the distance calculated from the opening price. So in our case it would be 70.98. So we would have shorted here and targeted this area here. And of course we need to always set our stop, because stops protect our capital and shield us from our emotions, as we are risk-averse creatures. So basically we dislike losses more than we like gains, and without stop losses we tend to let the losers run in expectations that they will be winners at some point in time. Now for the stop, with the calculation we get 72.36. So when we short here and place our stop here, we will not get stopped out, of course, and we will have a risk-reward ratio of 2, which is the generally recommended ratio. Basically, this was an example of a good trade. Other examples of exiting the trade: some traders prefer to set their targets based on the indicator. For example, they will not exit until the indicator reaches the oversold level. In the case of a short, meaning that a trader using this technique will exit only when the indicator reaches this area here. So he or she will exit around here. Of course, the problem with this technique is that the exit price is unknown, because we don't know what the price would be given an RSI level. So that was the strategy, which must be used with the risk management conditions. By setting it to 2, we only need 33.33% of hit ratio in order to break even, meaning that we can focus on improving it, on optimizing it, on tweaking the RSI so that we augment our hit ratio.